You're watching the latest news from FinancialMirror.tv. The Group of Seven warned on Monday that the surging yen posed a threat to financial and economic stability in the latest coordinated effort by the world's richest nations to curb the worst crisis in 80 years. The crisis continued to spread across the world, with South Korea slashing interest rates, Australia intervening in the currency market, Arab oil producers urging quicker monetary union, and the IMF bailing out Hungary and Ukraine. With the US Federal Reserve almost certain to slash interest rates later in the week, British Prime Minister Gordon Brown hinted that central bank action may be more widespread. MSCI's main world stock market index is down 50% for the year, while its emerging market counterpart hit a 4-year low as recession fears drove European shares to 5.5-year lows, and Chinese stocks closed at a 25-month low on talks of panic selling. Volatility has surged across financial markets as investors are forced to sell assets which they bought with borrowed money to repay creditors or cover margin calls as asset prices fall and credit limits are breached, fueling investor panic and unnerving policymakers. A brief G7 statement focused on the yen, fanning speculation of the first Bank of Japan currency intervention in 4 years. The yen's rapid 12% ascent against the dollar has threatened exports as the world's second-largest economy lurches towards recession. The dollar, however, is rising against other major currencies, so there was skepticism about whether any coordinated action on the economy would be forthcoming. Iceland said on Monday that $2 billion in aid from the IMF would not be enough to stabilise its ailing economy as it prepared for talks on the financial crisis with its Nordic neighbours. Prime Minister Geir Haarde said the funds were only a third of what crisis-struck Iceland needs to fix a broken banking system, restart currency trading and soften the economic downturn as the Northern Atlantic state reconsiders EU membership. One poll in Reykjavik showed a surge in support for adopting the euro and entering the European Union to 70% of those questioned. Iceland had refrained from applying to the EU as there were fears it would open up and sacrifice its fishing industry. Hungary, meanwhile, has reached agreement with the IMF and the EU in a deal that would help bolster the economy's near-term stability after its financial markets plunged in the past weeks and foreign investors dumped Hungarian assets. The IMF package is expected to be over $10 billion, similar to the $16.5 billion standby loan for Ukraine announced on Sunday. With the highest interest rate in the 27 EU at 11.5%, there was some good news for Hungary as Daimler said it will invest €800 million in a new plant to produce over 100,000 compact cars. British Prime Minister Gordon Brown has defended a surge in government borrowing, saying it would be wrong to cut public spending when the economy is contracting because of the financial crisis. Brown said that the responsible course of government is to invest at this time to speed up economic activity, adding that as economic activity rises and tax revenues recover, then you would want borrowing to be a lower share of your national income. Asked why the Bank of England had not cut interest rates more aggressively than the recent 0.5% to counter the downturn, Brown stressed the bank's independent, but said monetary policy did have a role to play at this time. The PM also hinted at the possibility that lower inflation, thanks to falling oil prices, could prompt central banks around the world to make more joint interest rate cuts. With data showing that the British economy shrank for the first time in 16 years, engineering firm GKN said it would lay off all 1,400 of its temporary staff, while the pace of decline in house prices in England and Wales accelerated to more than 7%. Brown said Britain would make proposals across the board at a G20 meeting in Washington next month, and that the IMF should be more like an independent central bank than the political committee it is at present. Expressing their disgust at the global financial meltdown, a small group of protesters from the anti-establishment attack movement stormed the Frankfurt Stock Exchange on Monday, shouting slogans and waving banners denouncing financial markets. The incident only lasted a few minutes as security guards escorted them from the building in the heart of Frankfurt's banking district. Nobody was injured and no property damaged. The banners said disarm the financial markets and put people and the environment above shareholder value. A trader on the stock exchange floor said the protesters had time to throw around thousands of leaflets. The protesters declared that the financial crisis is a symptom of a deeper-rooted sickness, calling for the casino, as they refer to it, to be closed, possibly referring to a recent protest outside the Frankfurt Stock Exchange demanding an end to casino capitalism. Less innovative and more traditional forms of crimeware are back in fashion as internet security experts discovered a direct link between the volatility of the world's major stock markets and the growth of new malware threats. The trend, scrutinized by PandaLabs, suggests that the number of cyber attacks has rocketed in direct contrast to the world's stock markets plummeting. These attacks were highest on the days when the stock markets dropped the most, while the recent spike in malware could be related to cybercriminals now having fewer targets as a result of consolidation within the banking industry. Ironically, the global recession might have translated into bad conditions for committing cybercrime, as hackers are increasingly worried that traditional Trojan attacks and phishing scams will not net the same rewards they once did. Rather than stealing credit card details, account numbers, and sensitive password information, the current wave of scams is tricking users into buying fake antivirus, with an average success rate of nearly 4%. That's it for now. Thank you for watching FinancialMirror.tv.